Nearly $1 trillion wiped out from the US market in a single trading session. That was a brutal reminder of how the market sentiments can really turn. Investors dumped tech and transport stocks. Broad sell-off across major indices was triggered. Dow, S&P and nasdaq turned red. Nasdaq slumped 2% by the closing bell. Meanwhile, S&P and Dow each fell more than 1% on Thursday, that is 12th of February 2026. But what is the reason behind the sell-off? What triggered the latest US market crash? Let's take a look. One reason was the stronger than expected jobs report. The report mentioned that US added 130,000 jobs in January. The unemployment rate declined to 4.3%. Now this data beat the expectations. But here's a full context. The US economy added just 181,000 jobs in 2025 versus the previously estimated 584,000. That signals underlying labor market fragility. Most hiring is concentrated in healthcare. Manufacturing and business services remain sluggish. Investors now debate whether the Federal Reserve will interpret the data as resilient enough to keep rates elevated or weak enough to pivot toward easing. So if the Federal Reserve pushes for higher rates, it could pressure tech valuations. And if there are rate cuts, it could support equities, but it could also confirm economic weakness. This tension fueled a sell-off in the US market. The other reason is the inflation data. Investors are waiting for the inflation report. The January Consumer Price Index report was being awaited by the investors. The concern is that persistent inflation could delay rate cuts, tightening financial conditions further. This also added to the $1 trillion wipeout. One other reason that also added to the wipeout was the quarterly update by Cisco Systems. At a time when everyone is debating on the impact of AI, investors found fresh reasons to reduce exposure. Cisco Systems delivered a quarterly update that failed to impress. Cisco shares plunged 12.3%, their biggest one-day sell-off since May 2022, after the networking equipment provider reported quarterly adjusted gross margin below estimates. The stock became the fifth biggest drag on the S&P 500. The disappointment also spilled over into other mega-cap names. Highly liquid giants such as Apple, Nvidia, Broadcom and Amazon.com came under pressure as investors trimmed positions in richly valued technology stocks. This tells us that good news isn't always good news. Investors appear to be shifting from enthusiasm to evidence. What do you think? Let us know in the comments section below.